S&P 500 up 0.04%. NASDAQ down 0.12%. Dow Jones up 0.21%.
Barely a pulse.
Right, the closing bell rang just 15 minutes ago on this Tuesday, May 12th, 2026. And if you just pull up the scoreboard, you are looking at a glassy, perfectly calm ocean today. The surface of the market barely registered a ripple.
But that flat surface is a massive illusion.
Completely.
I mean, it is masking a total frenzy of institutional positioning happening right underneath. We have a stack of end-of-day strategy briefs and raw trading data straight from the desks, and it shows a market in a deadlocked Mexican standoff. Nobody is actually comfortable here.
Well, the aggregate volume data totally confirms that. We finished the session 8% below the 30-day moving average. The real money, the pension funds, the asset managers who actually move the needle are sitting squarely on their hands.
Yeah, they are completely refusing to commit capital before tomorrow's 8:30 a.m. PPI and CPI prints.
Exactly. And for anyone managing a portfolio right now, you already know the stakes of those inflation prints. Producer price index and consumer price index dictate the entire macroeconomic weather. We're talking about wholesale costs and retail inflation.
And remember, the entire market is currently priced for the Federal Reserve to cut interest rates.
Right.
So if tomorrow's data comes in hot, if inflation proves it is sticky and accelerating again, the Fed's hands are tied, yields will violently spike. Nobody wants to be caught heavily long if that rate cut narrative suddenly shatters.
Which means today's flat price action wasn't driven by conviction. We didn't have buyers and sellers reaching a fair consensus on valuation.
Not at all.
We had a participation vacuum. High-frequency algorithms were just trading with other algorithms, creating chop, while the structural money stayed completely sidelined.
Exactly. When you strip out that high-frequency noise and look at the internals, the illusion of stability breaks down entirely. I mean, let's look at the breadth today. The advanced decline ratio closed at an abysmal 1 to 2.5.
Meaning, for every single stock that went up, almost 3 stocks went down.
3 to 1.
That is terrible internal health. Let's put that into perspective for you. If you are checking your 401k or your brokerage account right now, and you hold mid-caps, industrials, or regional banks, you're probably seeing a lot of red today despite those headline indexes finishing flat.
Yeah, the average Joe stock is already in a localized correction.
That's brutal.
It perfectly illustrates the concentration trap we are currently locked in. When the broader market deteriorates but the main index doesn't move, it's entirely due to market cap weighting. Capital is abandoning the smaller, riskier equities and fleeing into the massive tech monopolies.
It's honestly like a tug of war. One team consists of like 5 NFL linebackers.
Yeah.
And the opposing team is made up of 495 toddlers.
That's a great way to put it.
The toddlers, the regular stocks, are getting completely dragged through the mud right now. But because the index is weighted by size, those linebackers, the top 5 tech titans, only have to lean back a fraction of an inch to hold the rope perfectly still. It completely masks the underlying carnage.
And that is the exact mechanism keeping the SPX afloat today. It's a flight to quality, seeking out those fortress balance sheets. But here is the real structural risk. The linebackers are starting to look exhausted.
They really are?
We saw explicit cracks in the tech sector's armor today, specifically in the semiconductors.
Oh, the SOX index.
Yeah, the SOX opened up 1.2% this morning on a glowing broker upgrade.
A massive gap up that completely faded. It bled it all day and actually closed down 0.4%, hitting pure technical exhaustion right at its 200-day moving average.
It was a textbook key reversal.
Big players just used that morning pop, which was totally fueled by retail traders, buying the headline upgrade as exit liquidity.
That is the definition of a distribution day. When a sector gets flooded with good news, gaps up, and then immediately faces heavy selling pressure that drives it negative by the close, it means institutional capital is offloading their shares onto unsuspecting retail buyers.
Right, they're dumping bags.
Exactly. The AI premium, which has acted like a magic wand for tech valuations over the last year, is no longer strong enough to absorb the macro headwinds. The smart money clearly believes valuations in the semiconductor space have hit a hard ceiling.
But if they're dumping tech on the pops, and the smaller stocks are already in a correction, that money has to be flowing somewhere. It doesn't just evaporate.
No, it rotates.
And the strategy notes flag a glaring silent bid stepping into consumer staples today. The XLP ETF.
This sequence is fascinating.
It really is. A Tier 2 retailer completely missed their earnings report this morning, which caused the entire stable sector to gap down at the open.
Normally, an earnings miss in a bellwether stock drags the whole sector down for days. But instead, Massive institutional buy orders stepped in, violently rallying the sector to close at the absolute highs of the session. Another key reversal, but to the upside.
They are aggressively buying bad news in the most boring sector imaginable. Toothpaste, toilet paper, groceries. It's the ultimate defensive rotation. Meanwhile, consumer discretionary, the XLY ETF, tracking things people want to buy but don't need to buy, dropped 1.1% as retail spending data softened.
It is a massive tell. Institutional traders are actively building a bunker. They are parking their capital in low-beta, recession-proof assets.
Yeah, hiding out?
When the smartest desks on Wall Street are hiding in consumer staples while simultaneously using tech rallies as exit liquidity, they are signaling a high probability that the major indexes are going to roll over. They want cash parked where it won't evaporate if tomorrow's CPI print triggers a massive sell-off.
And that defensive posturing bleeds right into our volatility data, which, frankly, is throwing off massively contradictory signals right now. If we look at the VIX, the market's primary fear gauge, it actually dropped 4% today, settling at 13.8.
Which is wild. On the surface, a 13.8 VIX suggests smooth sailing. It implies market participants are totally relaxed and expect very little turbulence in the near term.
But the options data tells a completely different story. Even though the spot VIX dropped, the volume on VIX call options spiked 40% above the 20-day moving average.
A huge spike.
It's like the check engine light on the dashboard has been literally taped over. The spot price says everything is fine, but underneath, the mechanics are quietly hoarding fire extinguishers.
The reason the spot price is taped over comes down to market maker mechanics. Dealers are actively pinning the index. By keeping the S&P 500 trapped in this tight, flat range, they get to harvest theta.
Right, time decay. Every day the market chops sideways and does absolutely nothing, the time value of those options contracts decays. The market makers and dealers who sold those contracts were just sitting back watching the premium slowly drain into their own pockets. They are financially incentivized to suppress volatility and keep the market boring.
Precisely. They actively want the market to do nothing. But the institutional desks aren't stupid. They see the suppressed, artificially low VIX, and they are using it to their advantage.
Yep.
That 40% spike in VIX call options is institutional capital quietly buying crash insurance for June. Because the spot VIX is pinned so low, the implied volatility is incredibly cheap. They are buying massive downside protection at a steep discount.
And we saw the anxiety behind that insurance buying hit the actual trading tape right into the close today.
We really did.
In the final 15 minutes of the session, the closing print shows a $1.2 billion sell-side market on close imbalance. Institutions were aggressively fading the little bounce we saw around 2:03 p.m.
Fading the bounce is a pure defensive reflex. It means large-cap funds were actively selling into any late-day upward momentum. They were liquidating positions to get to cash.
Cash is king right now.
It's the ultimate safety net. No portfolio manager wants to hold overnight equity risk going into a high-stakes inflation print. That late-day drift lower proves they're prioritizing liquidity over any potential upside they might miss if the CPI print sparks a rally.
So we have a flat index masking a distribution day. We have terrible market breadth. We have a desperate flight into defensive staples and a massive institutional scramble for cheap crash insurance. So how do you actually navigate tomorrow's open-armed with this data?
The playbook is clear.
Yeah, the institutional playbook gives us a very clear line in the sand. The gamma wall at the SPY level of 5,950.
This is the most critical mechanical level on the board right now. A gamma wall represents a massive concentration of options positioning. Currently, options dealers are long gamma above that 5,950 level.
Which means their mathematical risk models force them to buy underlying stock when the market dips and sell when the market rallies. That constant delta hedging is what physically creates the choppy, flat action we saw today. They are essentially building a wall that traps the price.
But if the SPY breaks below 5,950 on high volume, that dynamic violently flips. That is the trapdoor.
Because if 5,950 breaks, the dealer's exposure turns negative. To keep their own books balanced, their algorithms will suddenly be forced to short the underlying futures.
And that forced selling will accelerate the decline.
Exactly, creating a rapid flush down to the next major liquidity pocket, which sits around 5,880. It shifts from a slow theta bleed into a fast structural liquidation.
Which is why the strategy brief explicitly warns against trying to be a hero. Do not aggressively buy early dips if we are trading below 5,950. Keep your cash levels elevated. The statistical probability of a massive sustained trend starting tomorrow is incredibly low. The models give trend continuation only a 35% probability.
Meaning we're likely looking at an inside day. The playbook is to fade the extremes. If the market rips in the morning on a knee-jerk reaction to the data, sell the rip. If it violently drops and holds support, buy the afternoon dip. You essentially play ping-pong within the established range until that 5,950 wall decisively cracks.
However, a lack of movement in the primary index does not mean an absence of localized opportunity. When capital rotates out of tech, it actively hunts for yield and macro protection. The brief highlights a specific asymmetric trade in energy.
Long XLE.
Right, energy sector call options targeting June expiration.
Energy was actually up 1.6% today, completely ignoring the flat market. The notes frame this as a 3-to-1 risk-reward setup, acting as a pure inflation hedge. If the CPI prints hot tomorrow, the dollar likely cools, supply chain constraints get priced back in, and energy is historically the primary beneficiary. You aren't trying to catch a falling knife in semiconductors, you are front-running the rotation into commodities.
It's a smart structural play. But we do need to address a glaring detail in the day 2 setups. Despite the broader weakness in tech and the distribution we saw in the semiconductor index, the institutional brief specifically flags NVIDIA as a high-conviction day 2 play for tomorrow.
I saw that, and I really need to push back on it. You just told me that tech valuations hit a ceiling. The semiconductor EPF suffered a massive pump and dump today. Yet the playbook says to look for an NVIDIA entry above Tuesday's high with a $155 target. Reconcile that for me. Is the tech sector dead or not?
It comes down to distinguishing between broad sector drag and supreme relative strength.
Okay.
The overall semiconductor sector is absolutely heavy, but NVIDIA is trading on its own independent structural momentum. It saw a massive wave of buying today right as it touched its 20-day moving average, and it did it with massive volume confirmation.
Right, it's forming a classic high-tight flag pattern. For anyone visualizing the chart, a high-tight flag happens when a stock violently surges up the flagpole and then moves sideways in an incredibly tight consolidation band. It acts like a pressure cooker.
Exactly.
The sellers are desperately trying to push the price down, but the institutional buyers are absorbing every single share without letting the price drop. The second it breaks above that tight horizontal range, which would be today's high line, the pressure releases upward.
And because it is the undisputed market leader, it has the sheer liquidity and momentum to hit that 155 target completely independently of what the rest of the tech sector is doing. When you have a high, tight flag bouncing off key moving average support with volume confirmation, you respect the chart, regardless of the macro noise.
The brief highlights one more localized momentum play, and this one is driven by a pure fundamental catalyst, not just chart technicals. Rocket Lab, ticker RKLB.
Oh, yeah.
They cleared multi-year resistance today, closing right near the highs because of a massively successful neutron engine test headline.
This is a textbook short trap. Rocket Lab has been stuck under heavy resistance for years. There is a massive contingent of short sellers who have been consistently betting against the stock at these levels.
But a fundamental catalyst like a major successful engine test completely changes the underlying math of the company. It triggered a breakout that traps those short sellers. Anyone who bet against the stock over the last 2 years is suddenly deeply underwater.
Right, they're trapped.
To stop their losses, they are mathematically forced to buy shares to cover their short positions, which creates a short squeeze that drives the price even higher.
The playbook dictates that any pullback to the previous breakout zone, right around 22.5U, is an absolute gift. The strategy is to buy that retest, anticipating the short squeeze will drive the stock toward a $26 target by Friday.
It perfectly highlights the duality of this market. The major indexes are paralyzed, waiting for inflation data. But under the surface, individual names with independent fundamental catalysts or extreme relative strength are where the active capital is hunting.
The primary takeaway for tomorrow is discipline. We just witnessed a severe distribution day masquerading as a neutral session. The flat S&P 500 is a total facade. We have atrocious 1-to-3 market breadth, capital actively hiding in defensive staples, and a massive scramble for institutional crash insurance beneath an artificially suppressed VIX.
So tomorrow morning, put an alert on your platform for SPY 5,950. Watch it like a hawk. If the inflation print comes in hot and the market forces dealers to break that gamma wall, neutral sentiment will turn aggressively bearish in a matter of seconds.
It is the ultimate tripwire.
I want to leave you with one final provocative thought to chew on before the bell rings tomorrow. We spent a lot of time today unpacking how passive index flows mask the heavy selling underneath. Because the S&P 500 is market cap weighted. Every single dollar that automatically hits a 401k retirement account blindly forces capital into those top 5 tech titans. It is an indiscriminate, automatic bid that acts as an artificial prop.
But what happens if tomorrow's inflation data is so incredibly hot that it actually spooks the passive investor? What happens if the retail market finally logs in and hits sell, overwhelming that automatic inflow? If the only thing holding up the massive generals of this market is blind, price-insensitive buying, do those supposed fortress balance sheets suddenly become a catastrophic trap? If the active capital has already rotated out and the passive capital panics, there will be absolutely no buyers left below to catch the falling knife. It is incredibly easy to admire the glassy, calm water from the deck of the boat today. Just make sure you aren't the one who falls in tomorrow.